stop buying stocks. And I know what you're thinking. Isn't stocks the best way to make money over the long term? Well, yes and no. Because if you're buying stocks, you probably think you know better than someone else. Because in reality, the stock market is a zero-sum game. Some win, some lose. But most people think they're on the winning side when they're on the losing side. So let me save you years of losing the market, losing to the market, not getting a return on your money by saying stop buying individual stocks. And the reason is because if you buy individual stocks, you're exposed to the risks of the company as well as the risks of the market. And if you know anything about Warren Buffett, the first rule of investing is to never lose money. And for some reason, even though I have a degree in accounting and finance, I've been an economics teacher for the last 10 years, I've been investing for the last 10 years, I am still tempted, and sometimes I still do make the mistake of investing in individual stocks. And everything is great when you're up 50% in the first 6 months on ExxonMobil because there's a war that is starting in Russia and Ukraine. But the moment you think to yourself, man, I did well, I did a good job, maybe I can do it again, and you put your money in some random stock like GameStop, well then, good luck with that. The same mentality that allowed you to gamble your way to a plus 50%, plus 100%, plus 200% return, and for some reason not sell, is the same mentality that will cause you to lose money. The same friend, real story, the same friend that bought Tesla at 150 and sold it, well, I don't think he sold it yet, technically didn't make money on it yet, but the same friend that bought Tesla at 150 will be the same friend who shorts Nvidia at 500. Sounds crazy, right? But it happens. Because we can't predict the future. And the moment I detached myself from getting a certain return, that is when I actually gained the most consistent returns over time in the stock market. So now my mode of operation is I just want to beat inflation. That's my only bar. And so what do I have? Well, I just buy S&P 500 index funds and I sleep peacefully at night. You know, a telltale sign of someone that's bought the wrong stock or does not know what they are doing in the stock market is if they check the stock price every day. And so let me ask you this. If you own individual stocks, do you check the price every day? Because if you do, I'm willing to bet that you actually don't know what you're doing. Unless you're day trading, in which case, I mean, I'm not educated enough to speak on day trading. With my limited education, I don't agree with the idea of technical analysis and day trading as a way of making money over the long term. For 99% of people, I know like somebody probably makes money doing day trading, but not the average Joe sitting at home that's trying to trade options or understand charts. Algorithms, maybe, but definitely not the average Joe is making money on that. And so there are a few questions you have to ask, right? Like if you want to know whether or not you will make money, the first question you have to ask is, if you're buying an individual stock, who are you outsmarting? Because it sure as heck isn't going to be Wall Street, right? Because they have access to information much faster than any average retail investor does, and they've got algorithms on their side. And their people are paid big bucks full time to do this. And so no amount of waking up at 5 a.m. to check the stock market or like check the early hours trading, no amount of that will help you outperform the day traders on Wall Street. Now, the weird thing is most active portfolio managers actually underperform the index funds, S&P 500 index funds, over the long term. And there's good reason for that, because if you are an institutional investor, you are subject to a lot of rules that retail investors just aren't subject to. And you also don't want to be wrong as an institutional investor. And so the question you want to ask is, how do I put myself in a position where I am strategically more advantageous than an active portfolio manager? And the answer is, well, passive index funds, passive investing. Because the whole point of active fund managers is they want to beat the market over the long term and get compensated for it. And that's why their expense ratios are too high. That's why their fees are so high, because we're making the assumption that they will, or they could eventually beat the market one day. Yeah? But the reality is that they don't. Yeah? They don't beat the market for the same reasons that the average Joe doesn't beat the market over the long term. Do they win in short-term trades? Yes, because they have access to information and algorithm in the short term. Yes, they can win on short-term trades. But over time, most active mutual funds don't beat index funds. And so that's why I just put my money in an index fund. The second question that I think you have to ask yourself before you buy any individual stocks, because I'm not going to say absolutely every person shouldn't buy individual stocks, because I'm sure some people do. And to those that do and should and do make money, they're probably asking this second question. And the second question is, how does this company actually make money, and how will it make more money? And what do I know or foresee that other people aren't foreseeing? Because if other people are foreseeing it, then it will be priced into the stock, right? And so most people that buy stocks don't even know what makes a stock or a share valuable. To most people, a stock price is just a number that goes up and down. It's the luck of the draw. It's a popularity contest. But you have to understand that while it is popularity contest in the short run, there is no amount of popularity that can keep a failing business stock afloat over the long run, right? Case in point, GE, right? It used to be the darling of the S&P, but not so much anymore because of their operational problems. And so if you're buying individual stocks, you have to ask yourself this second question. How does this company make money? How is its stock priced? And so there are two things that contribute to the value of a share. There's capital gains and there's dividends, right? So if the market, and I say market as in the investors of a particular stock in that market, thinks that the company will make more money in the future, then they think that the stock will experience capital gains in the future, because a stock's share price will grow to reflect the value of the business that it represents. And so that's number one, right? Like, will profits increase in the future? Yeah. And so that's the telltale sign number one, is like, can you actually tell the future? And if anyone says yes, well, no one should say yes. No, I don't think anyone should say yes to, can I predict the future? Okay, and so we can't predict the future. What can we predict? Well, we can also kind of predict. Well, that's kind of the future. Well, we can kind of also know the value of a stock is dependent on the dividend the company decides to give, right? The higher the dividend, the higher the value of the share, right? And so there are those two things that are baked into the price of a stock. And so when you buy a stock, are you buying it because you think the company will make more money in the future, or are you buying it because you think the company will be able to increase its dividends in the future? If you can't answer any of these questions, then you probably shouldn't be buying individual stocks. At least someone that is buying that stock is more informed than you. Even if you do know the answer to these questions, they are only an hypothesis, right? You don't know for sure because, again, it's the future. So you have a hypothesis on what you think the company will do in the next 5 to 10 years, which is not reflected in its stock price right now. Okay? And so there are a bunch of assumptions then that you have to account for, right? Like, what are the risks, right? Are there technological risks? Are there currency risks? Are there operational risks? Are there management risks? And you don't have to worry about any of these risks if you buy an index fund, because the only thing that you really have to care about is whether or not America will continue to be a profitable capitalistic country with major big companies that aren't failing anytime soon. And if they do, then others will rise up to replace them in the future, right? Like, is America's economy going to continue to do well, relatively well, compared to other countries in the future? If you buy an index fund, that's the only question you have to answer. And history says that throughout World War I, World War II, stocks have continued to do well, right? No amount of presidential changes, natural disasters can cause the stock market to not do well over 20, 30, 40, 50 years. In fact, no one has lost money if they kept it in an S&P 500 index fund over 20 years. No one has lost money. And now, here's the thing though. You only wouldn't have lost money if you kept your money in the fund without taking it out. The problem is a lot of people just take out the fund because they need to make a purchase or because they think they know better when they don't. And so you want to avoid those kinds of behaviors. Once the money comes in to the fund, the index fund, it does not come out ever unless you're retired and you need the money. Okay, now obviously emergencies are emergencies, but most people don't have good definitions of what emergencies are. And so their emergency fund just kind of depletes itself every few months. You don't want to be that person. So yeah, I guess this is my case for investing in index funds, and kind of a little rant on what I learned investing in the stock market over the last 10 years. I'll give more details in the future.